Hey, friends, welcome to today's Firstrade / market taker mentoring training. We got a good one for you today. This is a really, really good one, and are gonna, you're gonna freaking love it. I'm telling you. I'm just telling you that right now. Okay. Let's see here. Before we get started, I want to make sure that you can hear me. So please go to the questions box and tell me what type of calendar you use to keep track of your important dates. Is it Google Calendar? Is it the Apple Calendar? Is it the old Farmer's Almanac book with a blue pen? What type of calendar do you use to keep track of important dates? Outlook. Yeah, right. Conrad. Hey, Conrad, how are you? Nice to meet. Bisser. Gregorian. Yeah, that's good. Okay, good. I'm glad you're not still stuck on the Caesarean calendar. Mike, old fashioned paper. Well, I do some of that myself. I'll tell you the truth. S SS Weekly. I don't know what that is, TK. Huh. Interesting. All right. Well, while you're thinking about your calendar, do this for me. Mark a spreadsheet. Oh, it's a spreadsheet. Oh, Cynthia Google. While you're thinking about your calendars, do this. Mark Tuesdays at this time, which is 11 Central Chicago time where I live, noon East Coast time where I know a lot of you live, 9 a.m. Pacific time where I know a lot of you live, and 10 a.m. for all you mountaineers out there. Unless, of course, you're in Arizona, then you don't have daylight savings. And so I don't know what the heck time it is by you. Okay. Mark your calendars and add it as a repeating event because you know what? I put in the effort for you. I really do. I want to make sure that when you attend these trainings, you get better and better and better as a trader and investor. Bottom line is all I care about because I know that's all you care about. You're here because you're investing your time and your time is precious. And so I want to make every minute count. So today we're going to talk about time spreads, what they don't teach you. Before we get started, I need to point out that options are not for everyone. Please read, excuse me, hold on a second here. Please read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not necessarily specific to your situation. Now, I see some old friends, old MTM family members here, not old as in old and decrepit, although, hey, that might be the case for some people. I don't know. I haven't seen you in real life. I just know your names. But what I mean is old as in you keep coming back for more and more and more to further self-improve. And so I love that. Stay in the family. Those are the kind of folks that I love to help. My mother used to tell me when I was a kid, I would ask for something like, oh, can you do this for me? My mother would say, God helps those who help themselves. That's like ingrained in my brain because she said that thousands of times. Now, I don't think you have to be religious to appreciate the messaging there. Karma, nature, the universe, if you want to insert it for whatever. But God helps those who help themselves. But let me help you help yourself. And so, for those of you who are new to the Market Taker family, allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular option trading books. The one that I'm most known for is Trading Option Greeks, which is consistently ranked in the top 5 best options books ever written, which is, I don't know. Whew. I mean, I worked really hard at it. And so I am pretty honored and humbled to be in some pretty darn good company in that regard. I'm working on my next book too. That's going to be out in about 5 months. Oh my goodness. And I write a lot of articles. I do daily videos, which I know many of you watch who have joined Market Taker Mentoring, which I'll tell you about in a second briefly. I'm also a trader, just like you. I'm not some bozo who gets up here and talks about something that they don't actually do. I actually do it. I traded professionally on the floor of the Chicago Board Options Exchange, the CBOE, for many, many years. And now I trade in a retail trading account just like you, trading these strategies that I talk about. I'm the founder, president, CEO, chief content officer of Market Taker Mentoring, which is the global leader in option trader education. Often, what do they say? Often imitated, never duplicated. Is that the saying? I don't know. I would ask ChatGPT, but I'm doing a presentation here for you right now. I'm not going to do that. They take too long. I always I pay for ChatGPT. I put it on extra thinking. I think it works a little better with ChatGPT 5. But yeah, we are literally the global leader in option trader education. We've had people from other schools literally sign up for my classes so that they could learn what we teach, so that they could go and teach the scraps that they pick up to their people. It's weird, but I don't know, like, why do they even get into teaching options if they're not already experts? I don't know. It doesn't make sense. But we have students in over 50 countries. We put we've coached, I mean, including complimentary online presentations like this. It's probably 100,000 people that we've trained. And I and our head coach, John, are trading industry collaborators. We work with the organizations in this industry that do a good job in this industry. The solid, options friendly retail brokerage companies like Firstrade, those folks work hard for you. They get you this great information once a week that's free to you. They literally do want to help you be a better trader. It makes you a better customer, right? It's a symbiotic relationship, but that's good. There's some companies that don't care about their customers, but Firstrade sure does. I also work with a lot of exchanges in the world, media people. I'm quoted in the media pretty often. So I've been around the block. But outside of all that stuff, I'm also a family man. Those of you who are Market Taker students already who do some of our classes or use some of our scanners, you know Kathleen. She runs operations here, happens to be my wife also. I have my 2 adult children who no longer live with us. They both moved out probably for the final time, because those of you who have young kids but not adult kids, I'm going to let you in on two little secrets. One, it doesn't get easier once they turn 18. Sorry to say that, but it's generally speaking true. Phew. I used to think that when my kids turned 18, I was done. Like I won the game. Okay, thanks. You know, you're an adult now. We can hang out on holidays and, you know, that kind of thing. No, you're still there for them. And they, oh, the other thing, they keep coming back too. Like they move out and you're like, oh, okay, the kid moved out. Oh, empty nester. Nope. Temporary empty nester. Tempty nester. Come back and they live with you again, and then they move out again, and they come back and live with you again. But I think they're gone for sure this time, which is kind of sad too. I like having them around. And then I got my two little tiny dogs. One's usually in here sleeping on the couch behind me, but she's not here right now. And I also do other things for fun. I'm a runner, foodie, traveler, and musician. Now, enough about me. I spend way too much time talking about myself. I'm not the important person here. You're the important person here. That's the only reason I'm here is for you. So I want to help you get the most out of the time you spend today and the time you spend during the week working hard on self-improvement when it comes to option trading. And so if you go to marketstaker.com up here, market as in stock market, taker as in take what's rightfully yours, two T's in a row, marketstaker.com, and just go all the way over to the right-hand top side of the screen here and click on join free. There's a whole bunch of great free stuff for you. So do that. Okay, time spreads. Time spreads are also called calendar spreads, also called horizontal spreads, but they're basically conceptually, structurally pretty easy. Trading wise, there's a bunch of stuff that people don't tell you. All it is buying one option and selling another. They're both calls or they're both puts. They both have the same strike, but a different expiration. Now, typically, you're only ever going to buy a time spread to put on a position. You'll sell it to take it off. You're only going to buy it to put on a position. Most retail traders don't enter into short time spreads as positions. That's for a couple of reasons. One is because the margin is too high for retail traders to do that. It just kind of doesn't make sense for the amount of capital that is required to tie up. And the other thing is they're kind of weird too for the way retail traders trade, because professionals can make gigantic trades, and if implied volatility changes, which we'll talk about in a second, and they make like a nickel on 5,000 contracts, oh, that's $5,000. You know, they can make real money by trading big size and small profits. But, you know, us retail traders can't. We are putting on positions that benefit from time passing, a lot of time passing, or a market move. And so short time spreads, they have limited profit potential in that regard, and they have time working against them. So yeah, retail folks like us, we tend to buy time spreads. Now, what does that look like as far as buying time spreads? Well, I'm glad you asked that question. Let's take a little teeny weeny tiny looksy poo. So, oops. So let's look at, hey, what stock should we look at? What stock should we look at? Who's in class here today? Who's in class? Who's in class? Who's in class? Anybody have a stock that you want to look at? This is where Oslam usually throws something out. Meta. All right. Thanks. Thanks for your help, man. Appreciate it. So if we go Meta, the parents of Facebook, what is a time spread again? I'm buying one call, selling another. Same strike, but two different expirations. So we need to look at two different expirations. Wait, I forgot. Did Meta have earnings yet? I don't think so, right? Let's see. META investor. Typing this on my other screen. I got all these screens all over. That's the fun thing about being a trader is you can set up like a million screens so it looks really cool in your office. October 29th. They already had earnings, baby. Okay, good. We care about that. Wait, why do we care about if they had earnings already? What does that have to do with anything? Well, we care about that because for a typical long time spread, we don't want to have a position going into earnings. Why? Because, well, I'll show you in a second, but that earnings is one of the biggest. Oh, they just dropped big time after earnings? Oh, okay. We'll take a look at that too. Thanks, Visser. Did I say that right? I hope it did. Visser. So, earnings can be sometimes the biggest move of the quarter. And because of that, we tend to not want to put on time spreads before earnings unless it's a time spread that is specifically designed to make money on earnings, which BTW is also something that we do here at Market Taker, but it's out of the scope of what we're talking about today. We're just talking about regular time spreads. So since Meta had earnings already, and Visser brings up a pretty good idea here. Like we should probably look at the chart of Meta. Just for giggles here, as they say. Do they say that? Yes, I think sometimes they say that. Oh man. Meta got kicked in the pants. Look at that. Oh, goodness gracious. Meta hasn't had huge gaps. I mean, I guess last time was a kind of big gap, but nothing like this last time. But man, about 4 years ago, they had a massive gap like this too. Real kick in the pants. But you know what's weird about big gaps? Sometimes you get a few days of follow through, like looks like we're getting today. And then a lot of the time, it just found its level and it sits there. Now, I would personally want to give it a couple more days before making that thesis about the trade, a forecast about the trade. But, I would say statistically, that's typically what starts to happen right about now is volatility starts to slow down, starts to chill out. Sometimes get what they call a dead cat bounce, which is where it falls and falls. Where it falls and falls and falls. And then it just stays there. So that, friends, is not what's happening just yet, but it is a very common thing to have happen. I call it a dead cat bounce because you ever threw a dead cat? That's kind of how they bounce. They don't go boing, they go boom. Not that I've ever done it, but I've seen cartoons. I don't think they make violent cartoons like they did when I was a kid, but I think they were more fun when they were violent. Maybe that says something bad about me. I don't know. But I digress. So we could be getting a leveling off here. Okay, great. So let's go back to the options then. If we thought Meta was going to stay at its current price of, and you see it has it down here, 632-ish. 632.5 is what we nearest rounded to. We need to see different expirations too. Now, I like to sell shorter term time spreads. I'll tell you why in a minute. I know some of you probably already know, but I'll tell you why in a minute. But we could set up a time spread by selling these 3-day 632.5 calls and buying these 10-day 632.5 calls. Or the ones we could buy are the 17-day 632.5 calls. Or the ones we could sell could be the 10-day 632.5 calls and buy the 17-day 632.5 calls. As long as it's two different expirations and you're selling the shorter term one and they have the same strike, it is a time spread and it makes money. How? Well, we have to talk about absolute risk versus incremental risk. And those are my, made up terms, but they're kind of descriptive terms, so I like them. Of basically profit and loss diagrams are the Greeks. Profit and loss diagrams I call absolute risk because it's just from an absolute point, it's the most I can make, the most I can lose, and my break even. And that's it. It's very absolute value. Incremental risk is, well, what happens if the stock moves $1.32 today? What happens if 4 days pass? What happens if implied volatility changes by 3 points? We use the Greeks for those, but we want to start out with that absolute risk. We want to start out with the time spread. Oops. So the time spread here, it kind of looks like this. So Meta, what is strikes? I said 632.5. It's the shared strike price. It's got the same strike. And so we want it to be where? Well, you've seen these profit and loss diagrams, right? What this is, as you can see, the horizontal axis is the underlying stock price at expiration of the short-term option. There's two expirations. Usually with profit and loss diagrams, you just say, oh, it's at expiration. But there's two expirations. You can only consider one of them. And so we have to consider the first one because if we consider the second one, the first one's already gone. And then the vertical axis is our profit or our loss. And, this is our break-even line, the horizontal axis. Above here is profit, below here is loss. So as you can see, what we really want is the stock to be at the shared strike price, which is the strike price of both options at expiration. So in the case of Meta, that is 632.5. But if it goes down or up a ton, we can lose money and we can lose everything we paid for the time spread. So 100% loss. Now it's a leverage loss. It's not like, if we buy 100 shares of Meta, we're paying $63,238. and that's a lot of dough. If we buy this time spread, we're paying like, what were the prices here? $8 or $800 of money. So when I say lose 100%, if we're trading smart and managing our contract size, 100% is not like some big deal or anything. If we're loading up and trading super leverage, it can be. But we can get a pretty leveraged profit too. Like, this is just sort of a artist rendition here. Gosh darn it. Sort of an artist rendition here. But whatever amount we can lose, a lot of times we can make about that much. Like, it's not uncommon to have our maximum profit 80 or 100% of what we invest, which is our max loss. Though we tend to want to close these before earnings. How do we reach our max loss? Well, if these are calls, if the stock goes down just a massive ton, both of those calls are so far out of the money they're worthless. If the stock goes up just a massive ton, both of the calls are in the money and could be exercised or assigned, but that would be at the same strike price. So that means I could exercise my calls and buy the stock at 632.50, but I'd also get assigned and sell the stock at 632.50, which is a break even. So I would lose what I pay for it. Okay, so we also care about the Greeks. Here, hold on a second. Let me get rid of that misleading thing there. But we also care about the Greeks. And so here's what we're going to want to do. We can do this. I track a lot of my option trades in a spreadsheet. There are other ways to do it too. There are online services and such stuff you can do online. But if we go to, instead of chain type calls and puts, we go to Greeks and analytics, or wait a minute. Actually, if we just go to call a calendar spread, let's just start there for a second. Oops. These are 1 month call calendar spreads. This nicely just sort of does the math for us. Here's the bid, here's the offer. And it just defaults to the next expiration, which a lot of times is kind of what you want to do. Now, another thing we can do, though, oh, goodness gracious, is go to the Greeks analytical. And there, if we pull up both of these, we can say, well, what's the delta of the 232 calls on both of these? Well, let's see. I'm going to be selling the short-term one, so I'm going to be getting short. We'll just round this. I always just move the decimal point in my head to make it basically the equivalence of shares. So 49.5 deltas that we'd be getting short. And we'd be buying these, so 51 deltas. So it's like a 1.5 delta. It's basically delta neutral, flat. The gamma is the important thing here, though. Gamma is your risk with time spread. That's how you can lose money. That's how your deltas change. So this is because they're selling at negative 0.15, positive 0.9. So basically our delta changes 4 deltas against us every dollar meta moves. And it's a $600 stock. So, I mean, stocks move in percentages. Like, look, today it moved $6. Sounds like a big move. If it was like the Ford Motor Company, that'd be a gigantic move. But here it's only, it's 1%. So it's not a gigantic move for a stock, especially a tech stock. So, that means our delta changed 24 total deltas. So, we would have lost a little bit of money, but not a lot if we made this trade. Rho, we don't really care about for these short-term trades. Theta is what we really care about, though. Every one contract we sell, we make $1.71 of option premium a day. That's $171 a day we make on the short options. Now, we give up some of that on the long options, which we need as a hedge. We give up, let's just round it, 86 cents of option premium, or $86 a day. So we make, I got my handy dandy little calculator that I bought in about 1992, I would say, just at a drugstore. Texas Instruments, and the frickin' thing still works. That's pretty impressive, isn't it? And I don't even think I ever changed the battery. How is this possible that this is still working 25 years later? This is incredible. I probably paid $5 for this, and that was 25 years ago. Look at a chart of gold, and that'll give you an idea of the inflation rate. How is it even possible this thing still works? I don't know, but I use the darn thing every single day. So anyway, the options we sold here, we make $171 a day. The options we buy, we lose $86 a day. We're making a net of $85 a day per contract. Wait a minute. How much are we investing in this? Well, let's go back and just look at calendar spreads. Easier that way. If we're buying this, which means we're buying the November 14th, selling November 17th, we'd be paying about $6.50. Now, with spreads like this, yeah, Lisa, yes, I will in just a second, okay? In spreads like this, we can usually middle the market. So we're probably not paying $6.50, which is $650 a contract. We'd probably get away with paying $6.40. So on a $640 investment, we make $85 today on theta because it's at the money. The theta of the short-term option gets bigger at a faster rate than the longer-term option. So you make even more tomorrow and even more the next day. Holy crap. If Meta stays here, we can do pretty darn well. Now let's look at IV and Vega. Vega is 227. Just call it 23 cents on that one and 42 cents on this one. Let's just say 22 and 42. So 20 cents, but it doesn't really matter what the net Vega is on time spreads. A lot of people think it does, but it's not really true. Seems like it should be true. Well, we care about the individual volatilities. That's what we care about. These have a 42 volatility. These have a 39 volatility. These are expensive. The ones we're selling are high versus the ones that we're buying, which are lower relatively. So we actually get an edge by trading this. So delta, we always want to be delta neutral. Gamma is always going to be negative. There's nothing we can do about it. Theta, we want it to be positive, and it always will be if we're near the money. And Vega, we don't care about the net Vega. We care about the individual Vegas. Now, next with time spreads. No, we already talked about that. Next with time spreads. There's a thing when it comes to stock trading. Sorry, guys, my throat is like, must be my allergies today. It's weird. Like you think about allergies happening in the spring, but you know what? Sometimes they happen in the fall because of mold and stuff. We had a little bit of a rain on Friday, probably got a little bit of mold under some leaves. And now I'm like hacking up a lung over here. But there's a thing when it comes to stock prices. And this is where you ever hear people talk about quants? Quants are like the super genius smart people in our business, option trading. They have advanced math degrees and they create mathematical models that make near arbitrage or riskless profits. Then you want to be one of them? Well, you got to go back to school for about 6 years. And then you got to be pretty darn smart to begin with. And then you got to get a job at one of these companies that kind of train you on how to do it in real life. And they make you sign an NDA, which, for whatever. So it's hard to become one of these quants, but hey, anything that's worth doing is hard, right? That's why you're here studying, investing in yourself. So quants and professors, they believe that stock prices are log normally distributed. What that means is, and this, by the way, is not a log normal distribution. This is a bell curve. Log normal distribution is shaped kind of like this, but a little bit different. But this is close to darn enough. So what this means and what this says and what the smart people believe to be somewhat true in a modeled universe is if I were to take the last 30 days worth of trading, if I were to take their closing prices, we would see that a lot of them end up being pretty clustered towards the middle. And we would get what we call a mean or average, not nice, but average mean price if we looked at them. And so that's because most of the prices are there, but some of the prices would have closed farther away. This gives us an idea of the volatility that typically happens with option prices. Now, again, some of this is an oversimplification. Some of this is my lack of skill in artistic drawing or my lack of skill in being able to program a spreadsheet to create one of these drawings. Anybody know how to create a drawing of a probability of a log normal distribution on a spreadsheet? If you do, email me. I got something interesting for you. Dan@markettaker.com. So now what's interesting here is, remember this? Well, it kind of almost looks like this. I mean, a little bit. And so what that means is that most of the time that you trade a time spread, you're likely to win. You're likely to make money. But if there's too big of a move, you lose money. So from a probability perspective, the most probable outcome can be that you make money. But there's some nuance there. That's not like a always accurate universal statement. The problem is even though it might end up closer to the strike more often, the price you make the time spread trade at matters. And this is where that whole Vega volatility thing comes in. We want to sell overpriced options. and buy underpriced options. It's got to be relative to each other. And so what I'm talking about here is sell high volatility and buy a lower volatility implied. So we're going to need to use theta, gamma, and vega and volatility term structure. Oh my gosh, so many fancy terms here, but don't worry, it's not really as hard as it sounds. Delta and direction don't really matter because we're going to put on a delta neutral trade. But gamma and theta and implied volatility vega, that's everything. If the stock moves too much, which is you lose, which is negative gamma. If the stock stays in the middle, you make money on theta. But here's a big secret. And I'll tell you what, if you have listened to my Firstrade webinars in the past, there's what if you take one thing away from them, and it's a theme that runs through all of them. Every single webinar I do on Firstrade, at least implicitly, if not explicitly, revolves around the idea of getting edge on option trades. That is how professional traders make money. And that is how good non-professional traders make money. Anybody who doesn't trade for edge loses money. Now, you might be saying to yourself, but Dan, I don't look at this edge thing, and I actually do make some money. I do okay. Well, you probably have a system that has an edge built in, but you just don't use that word. An edge is any statistical advantage that leads to profitable trading. But with time spread, this is how you do it, whether you realize it or not. So with any trade, we need to look at the technicals, look at the fundamentals, volatility, state of forecast, and select a strategy based on that. Review the Greeks, come up with an exit and adjustment plan and an execution strategy, then exit the thing, then adjust, and then do a post-mortem. This is what a lot of people focus on and what you need to focus on so that you can select the optimal strategy. Now we're talking about time spreads. We're looking for a time spread, but which time spread? Do we do the consecutive expiration or do we skip a week? Do we do this strike or that strike? Do we do the call time spread or the put time spread? So let's talk about that. Your risk is always negative gamma, which means the stock moving too much. So we want to, from a technical standpoint, look for range-bound stocks. Now, when we looked at that Netta chart, Lisa, what stock would you like to check out? I didn't forget about you. I would never forget about you, Lisa. Meta. Is this a range-bound chart? Well, no, not over the last 2 weeks. But we don't care about the last 2 weeks. Unfortunately, we can't put on trades retrospectively. Don't you wish you could? Like, wouldn't it be cool if I could put on a trade that expired that like starting a week ago after knowing what the future holds? That'd be great. It's never going to happen. You can only put on trades going forward. And that's why I say a lot of times we see this. It's what a guy I work with calls stocks either rest or run. Well, this is a run down. But a lot of times when we get that big run, they tend to take a break. Like here, it ran, and then sat still for a while. Had a big jump, had some follow through. Actually, it ran back down. This is not a good example of that, but this is a good example. It had a lot of up and down running and then rested. So, maybe we get that rest. But, oops, I always do that. Why do I always do that? But Lisa wants to look at INVZ. Indigo. I always try and remember the phonetic NATO alphabet. I always forget what some of the letters are. What's N again? Is it Nancy? I don't know what it is. I know it's indigo. That's all I know. But yeah, Lisa does ask an important follow question. Does this trade options? Because if it doesn't, don't matter what the chart says. And geez Louise, it's taken a million years to pull. Oh my gosh, and it's $1 stock. Yeah. I'm not even getting a decent chart here. Plus, dollar stocks are pretty hard to trade options on. Yeah. Lisa, let's look at a different one. Dollar stocks don't make good for time spread candidates. What's November, TK? How about Wolf? All right, well, this is a $15 stock. And there's nothing wrong with trading dollar stocks or $15 stocks, but they are a little more challenging when it comes to options. I usually Oh, thanks, TK. November Victor Indigo, November Victor Zulu. Ah, Zulu, I should have remembered. And Victor too. November, I kind of forget, but yeah, I usually like to look at stocks over 20 bucks for really any option trade. And this one is not really a steady stock. This might be a great one to trade, or it might be a terrible one. I don't know. I'm not familiar with it. But for time spreads, neither of these last two are good, which is great information. I'm glad you asked that question because you want to know what not to use these on as well. Who has a nice, boring, old, steady stock that's been trading sideways? Target. That's right. I was just looking up Target the other day because I'm using it as an example in my upcoming book on trading the wheel. Target is not super steady. 10 bucks range is about a 13% range, 14% range in less than a month. They will have earnings coming out again soon. They're a retailer, and retails announce a month later, so they'll be having their earnings probably within the next 3 weeks. I actually just looked at it for the example for my book. Oh, it's India? Gosh darn it, Cynthia. Well, some things I'm interested in a lot of things. And that just means I'm always learning. And because you're always learning, you don't always know the answers. I only know the answers that I know. India. I thought it was indigo. Gosh darn it. Now, maybe I'll remember that. Oh, you can't see others' comments? Oh, okay. Well, that's okay. So Target, I mean, it might not be a terrible example, but I mean, going from almost 100 to 90, 10% drop in just over a week after a 10% rise in just over a week. I like to see something even more boring. Even more boring. Isn't that funny? You show up to a webinar on trading, and you know what we want to look at? Boring stocks. Why would you want to attend a webinar to look at boring stocks? Because it's not boring when you're making money. And with time spreads, that's how you make money. Now, Coinbase is in a pretty good range. Is it? 80 to 320, 60, I don't know. I mean, for a stock like this, it's in a pretty good range, and probably the options are so expensive that it might make up for the kind of actually pretty volatile. Let's just look at coin. How can you scan for a boring stock? I mean, there are software stuff out there. I don't like to give recommendations, but just Google it. Or, I mean, honestly, you know what I like to do is just flip through charts. Coin is interesting because of volatility, because of the volatility of its stock, yes, but it makes for a very uninteresting time spread, unless the thing that's interesting to you is how much money can I lose in the shortest period of time. For other types of trading, it's very interesting and it's great. For time spreads, I don't know about that. Let's find out. So this is the chart. Here's, you know what? Here's what I'm going to do. I love just taking screenshots. I probably take 15 screenshots a day. And that's just on a regular day. Gosh darn it. Gosh darn it. Hey, hey, when like you. Click wrong button. So now there's the chart. Let's look at the option. I always like to go with the shortest period of time for the selling one because it has the highest theta. Right now, Coinbase is at what? 312 or so. Well, 311.66 down here. So we'll look at the 312.5 options. Just look at the prices first. We can sell these for $8.50. Buy these at $14.25. Or here, let's make it easy on ourselves. Let's just go to the calendar. So we can buy the calendar for $5.75. Now, truth be told, we can probably middle that. There's never a guarantee you can middle it. But let's just say we can buy it at $5.50. So that means 3 days from now, this stock can't be up or down more than $5.50. Well, wait a minute. That's not actually true. I don't know about this one, folks. I don't know about this one. let's look at a different one. I think it just had too much movement. The cheaper you can buy it, the better. Who sells boring stock time spreads and for how much? Aren't they dead for trading options with large buy sell spreads? Well, we don't sell time spreads, we buy them. And boring is what makes you money. Like, look, let's take driving a car. And let's take two types of drivers. One is the guy or gal who delivers my Amazon packages. If that person drove like a maniac, they're driving through traffic in residential streets. They would get in a crash or they would get fired. It's a terrible way to do your job if you're an Amazon or UPS driver, to drive like a maniac super fast. If you're a race car driver, you got to drive like a maniac super fast. I mean, probably not like a maniac, but it seems like a maniac from the outside. They're very controlled. But, you know, they're two different ways of driving. With a lot of stocks, we're looking for breakouts. We're looking for volatile stocks. With most trading, we are. With time spreads, we're not, which is good because then you have an extra tool in your toolbox. Is NVIDIA boring to me? Probably not. But let's look at what Cynthia says here. Morgan Stanley. It's kind of boring, which is good. Not a big major move. I mean, over in this month, it went, in the month of October, it went from about 157 to 164, $7. And that is a small range. It is kind of trending upward. So if we're picking a strike, we want to pick a strike a little higher. Right now it's trading at 164.81. So 165 strikes, since it's a smidge higher, would be better. If we have to choose a higher strike, maybe 166. We got to see what kind of strikes they are. But this one is interesting to me. It's interesting because it's boring. And believe me, I'm going to do plenty of workshops on stocks that are not boring. But it's my objective for myself and for you to make money in every type of market. So if you're good at finding those breakouts, those volatile ones that move a lot, by gosh, keep doing it. But when you're looking at a stock and you're like, oh, I thought this was going to be a good one for volatility and breakouts. It's not. It's boring. You now have another tool in your toolbox to take care of that, don't you? So this one, for 3 days, I mean, you could buy this. You're only risking probably about $1.50. Good, Lisa. You're risking only about $1.50. So this is an interesting one because it's not interesting. See? So the most I can lose is whatever I pay for this, like $1.50 or so. But I can make, probably about a good $1.25, $1.50 or something. We always want to have, though, the volatility spread. Whoops. The volatility spread. So we always want to have the one we're selling, 165 calls, We'd be selling them with a 38 volatility. 165 calls that we're buying those at a 33 volatility. That is one of the biggest secrets I can tell you. If you're always selling a higher volatility than what you're buying, you have a much, much, much better chance of making money because you're doing it for an edge. All right, friends, that's all the time we have here today. We covered a lot. There's so much more to learn. So I hope you've marked your calendars and show up a week from today for more, where we're going to talk about against the odds, buying options and winning. That's one where we're looking for exciting stocks. The other tool or series of tools in your toolbox. Until then, friends, have a great rest of your day. Trade smart, and I'll see you next week. Bye.